Hello, good afternoon. Welcome to MF Corner on CNBC TV 18. I'm Vinny Motiwala and with me my colleague Sonal Bhutra, as always. Sonal, good afternoon. Today we have AMFI data that's come in as well and important updates that have come in here as well. But first,
oh yes, good afternoon. And the big talking point has to be what's happening with gold ETFs, the way silver ETF flows have increased. And now they're topping equity funds. In fact, them combined together are more than equity fund flows. So that's the big headline that we are taking from today. But to take a few questions and understand what's happening here, we have Prableen Bajpai, who's the founder of FinFix Research and Analytics. Prableen, good afternoon. Thank you so much for joining in. The big question has to be around the gold ETF and silver ETF funds. Gold ETF is now as much as equity fund flows. Do you think this is a FOMO trade that happened in the month of January and it has topped or peaked now and we could see fall, and this fall could be steeper in fact?
Hi, good afternoon, Sonal. Such amazing figures. It's really interesting to see how the gold inflows have topped this month for January. Amazing. So let's give a bit of a background, Sonal. This also comes at a time when I think a lot of factors have actually helped push this data upwards, because I think you don't have any availability of SGBs. I mean, new schemes are not being launched. We've seen rupee depreciation, so gold prices, going up. We've seen weak equity markets as well. And there is some news or the other on the geopolitical front. So I think with all of these factors, gold and the kind of returns that it's shown in the recent past, definitely, a lot of investors have been not only perhaps, it would be wrong to say that everybody is looking to chase past returns, Sonal, but definitely it is also at a time when people perhaps realize that this asset has to be there in their portfolios and probably just trying to add that little bit there. And I think another very important factor is also that, 2 years back, we had that change in the taxation when gold became taxable at slab. Last year, 2024, that was changed. 25, sorry, that was changed. And this year, now we know that it's taxable at equity. So I think all of these factors cumulatively are helping gold. But of course, the data is spectacular. We haven't seen anything like this. December, we had about close to 12,000 crores come in. This month, it has been 24,000 crores. So I don't think this sort of an inflow is sustainable, Sonal. But, given the trend, if you're looking at the fall in the equity markets, which started in September 2024, the correction phase, till now, Nifty is still down 1.13% and gold is up 100%. So I think, it's very natural for investors to somewhere move towards an asset class which feels safer, which has delivered returns. And so not the same level of sustainability perhaps going forward, but I think some addition of gold definitely should be there in all portfolios, but from a very long-term point of view and with moderate return expectations going forward.
Absolutely. That is key, right? Moderate level of expectations in terms of returns. We are not going to get every year that we saw as 2025 and right now for a gold returns as well. Probably good afternoon. You said that obviously everyone wants a part of gold now. So in some way, multi-asset allocation funds have also been in trend for a while. Even in Jan AMFI data, if you look at it, we've seen a very sharp jump up. Inflows coming in over there, also highest ever, 10,485 crores. Your thoughts on multi-asset allocation fund? And is it a better play maybe to look at multi-asset allocation funds versus gold ETFs also?
So multi-asset allocation funds, I think, Vinny, have always been, a very good category, especially during downturns. If you look at previous data also, for example, the last two falls post-COVID, when we saw Nifty correct by 15-16%, which was, October 21 to June 22, and then September 24 till roughly March, April of 25. With both these falls, we saw that good multi-asset funds were able to contain that 15-16% fall in Nifty as low as 3 to 5%. So almost 1/3 of the fall, 1/5 of the fall, Nifty's fall was contained. So I think given those kind of downside protection, which multi-asset funds, some of them, not all, of course, showed, I think, naturally, even in times when equity markets are not doing well, there was a natural inclination to move towards something which can contain the falls. At the same time, the returns for multi-asset allocation funds, if you look at during the same time period, it's interesting to see that when Nifty has delivered negative 1.5% since September of 2024, majority of the multi-asset funds have given 95% of the time have delivered actually double-digit returns. Only one of them, the lowest returns in the category for this type, these 14, 15 months is actually 7%. So multi-asset funds, again, Vinny, makes great sense, to have it in the portfolio because the fund managers have that flexibility to reduce your silver, reduce gold. If they feel that, these segments are getting overheated, they can move into bonds and equity. And I think it can be a great way actually to take exposure to gold and silver, only if you, leave it to the fund manager. But of course, I think, again, return expectations from even this category overall has to be now, it may not be the kind of returns that we've seen in the recent past because, these assets, silver and gold, have actually really, really supplemented the returns over there.
Makes sense. A lot of it came from precious metals, right? Be it in multi-asset funds or gold ETFs and silver ETFs that we've been talking about. The other part that we speak about very often in the market language is the mid and small caps. These funds have seen a decline month on month, despite an indication that maybe mid and small caps, after reporting good earnings, could start to recover. Is that an indication that we're getting despite the decline that we saw on a month-on-month basis? What explains that?
So I think, Sonal, honestly, I feel that retail investors have shown a lot of resilience, in the face of very sort of turbulent markets, especially in the small cap space. What we see today, let's say 2-year-old SIPs, 3-year-old SIPs in small caps, mid caps show very meager or low returns. If you're just looking at the movement of, since September 24 till now, we still see that a lot of small cap funds are in negative. So considering the kind of performance we've seen in these segments, I feel that the little dip that we've seen in these two segments is not bad. Actually, it's lesser than what we've seen in the previous months because somewhere maybe, there is some bit of tiredness which starts to setting. There's a bit of frustration as well when you've, given you've continued with your SIPs and the returns are still negative 5%, 7%. And at a time when some of the other assets like gold, silver, especially silver, like plus 160% returns, they're shining. And then with, I think, limited assets, how much does a retail investor have? So you definitely can have the tendency to, move and allocate from one category to another. So I think that is understandable. But I think still the mid cap and the small cap data is decent given the current market conditions.
Prableen, anything else that stands out for you in the AMFI data as well? Also, debt funds, that also seems to be the flavor or, continue to be the flavor as well. Your thoughts on that as well?
So in debt, especially liquid, Vinny, there's always a lot of seasonality. So, tax seasons and company big money coming in certain times. But if you're looking from, investors that we speak to, debt definitely has lost a bit of its charm. And I think that is also where maybe categories, especially the conservative categories, for example, some of the balanced advantage funds or those multi-asset funds which are having lower component of pure equity have attracted investors. And of course, within hybrids, there are other categories. So I think overall, that little bit of AUM shift is there. Although I feel in the debt space, it is mostly the overnight and the liquid funds which actually, really move the overall data. And that comes in from corporates. But from, I think, retail investors' point of view, I don't think that they've been able to make a major dent there. But I think the hybrids are definitely getting that advantage. We do have newer categories. We'd also have things like fixed income plus arbitrage, all these categories which are more tax efficient, which are giving us a combination of fixed income plus, equity taxation. So I think for investors, that's big. And of course, silver, I think that's one thing which has attracted so much. I mean, amongst all the data which has come in, not only that gold is equivalent to the equity inflows, that's something that Sonal already mentioned. And other than that, I think the increase in the number of schemes for silver which have been launched overall, that's something, last year we had about 8 schemes in silver. Now we have 14. And the rise in the AUM of certain schemes, Vinny, for example, SBI, the FOF, for silver moved up from like 300 crores to almost 5,000 crores. ICICI saw that big jump, doubling its AUM. Nippon just from 500 crores to close to 4,000 crores. So I think all of these things definitely show that there is a bit of recency bias, but there's also a
Okay.
shift that investors are doing.
Take that point, Prableen. Always a pleasure speaking with you, but we are out of time, so we'll take this conversation ahead some other time. With that, we'll slip into a short break. On the other side, we speak to Raghav Iyengar, CEO of 361 Asset Management.